Ben Pitts, thank you so much for joining the podcast today. I'm excited to have a really good chat.
Yeah, likewise, Josh. I appreciate you having me on. I've been listening, and I actually went back and looked. I was curious. I've listened to 8 of your 36 podcasts so far, and it's like a classroom for me. So you've touched on compliance and growing a plan advisor firm, and the M&A in the space, and some tech in the space, and participant engagement. So it's been a good classroom for me. Trying to help innovate in the space and hear what the perspectives are. So appreciate you having me on.
Awesome. Absolutely. And you and I connected really just kind of a couple of weeks ago. I think you had reached out to me on LinkedIn and I think maybe or maybe we got connected. I can't even remember how we originally connected, but we did a quick. How was it? How
I think Aaron Schumm may have told us to connect, so I reached out to you, and but yeah, it was the old cold call with Aaron told me to call.
yeah, and I have lots of time nowadays, so I tend to when I think something's interesting, I tend to happy to kind of hop on and learn about it, and that's actually what we did. We connected on Zoom and. You demoed the technology platform that you built, and I was impressed, and as we talked more and more, I was like, man, I'd love for you to kind of come on the podcast. So that's kind of how we've gotten to where we are. Now you're a partner. You're part of TIFIN, which I'll let you to kind of describe what TIFIN is. Mm-hmm. But you've got a really cool, what I would consider to be one of the businesses, because it's obviously, I think, it's kind of an incubator for different kind of tools within the financial services and the wealth and the investment world and the retirement world. But a really cool, what I would consider kind of lightweight but powerful planning platform. And when you showed it to me, I was definitely kind of impressed by it. And it sounds like you guys are starting to started kind of on the wealth side, but are making some pretty good inroads with retirement plan advisors. So we're gonna chat about that. But why don't you, for the audience, I think retirement advisors probably are not as aware of TIFIN as maybe kind of the wealth side is. Why don't you tell a little bit about TIFIN and a little bit about your background? Because I think you have a unique kind of origin story in all of this as well.
Yeah, sure. I'll start with TIFIN, and then I'll rewind back to how I ended up here. TIFIN is a fintech company. We're about 250 people, headquartered in Boulder, Colorado, and most of probably half of those people are engineers. And our founder, Vinay Nair, started the company after starting a company called 55IP. 55IP was one of the early companies in the really enabling this, fractional shares, building portfolios for people that mimic an index and do it efficiently. So he ended up selling that company to 55IP to JP Morgan about a little less than 2 years ago. But before he sold that company, he was, I think, playing a chairman role and had started TIFIN. And his idea was he wanted to impact the world, and he wanted to build fintech companies and essentially, fund founders that wanted to have impact on the world. And so we started a company called Magnifi, which is natural language search, doing investment research, kind of Googling, think Morningstar. Morningstar also doing research, but doing it with a natural language. Really cool. There's some patents on that platform. So that was one of the first. Clout is a digital marketing platform for advisors, social media and email, which I believe was the second company. And then, there were several other companies that popped up from that. And this is going back only about 3 years. So TIFIN stands for Technology and Intelligence in Finance. And what we're doing, we're on a mission to build engaging wealth experiences that improve, financial well-being for people. Started in America. We actually are just starting an international business as well. But the way that I ended up getting here, so we've got, and by the way, today TIFIN is not really an incubator. We're building this as one team, one culture, our products are integrating together, creating more value for the advisors and the consumers that we touch, as well.
You guys have raised a ton of money, I think, right? I think you've raised north of maybe $100 million, something like that.
Yeah, I think it's close to 200 million now, and that's all happened in the last 2 years or so.
Didn't mean to shortchange you. 200 million, a lot more than 100.
Any of it personally, Josh. That was all Vinay and Jack, our CEO and president. But yeah, raised quite a bit of money to fund a big vision. So our investors today are Morningstar, J.P. Morgan, Broadridge, and then most recently in our last round that we closed about a month and a half ago, Franklin Templeton came in as a strategic investor as well. So those are our core strategic investors, and we actually have another more VC that focuses on fintech, and frankly, the name's slipping my mind right now. But yeah, so we've raised quite a bit of money, but it's all about really is about impact. If you were to sit down and chat with our CEO Vinay, he really has a vision of impact, and that's what attracted me to TIFIN. So I've been here. I joined in April 1st, 2021, picked up my family of 5 in New Jersey and moved across the country to join TIFIN. And I did that because I sold a technology platform that I was building for the last, at that point, I could think about 7 years, to TIFIN to start over with what at the time was called Plan IQ, is now called TIFIN Plan. It's a lightweight financial planning tool. Think eMoney, or Money Guide Pro, but much more streamlined, much faster. The ability to build plans for people in minutes, not hours, right? Just trying to get somebody put in the right direction. And ultimately, so going all the way back, that's sort of the end of that story before I joined TIFIN. I actually started in the wealth management industry back in 2008 as an intern. I was at the University of Virginia getting an MBA. Goldman Sachs was recruiting there, and I thought, man, wealth management seems entrepreneurial. You're working with entrepreneurs, and I want to go out and build my own business. Did that for about 3 years. And while I was there, I met another guy who was an analyst on the team, brilliant, kind of a quant. We both grew up in Southern New Jersey, shared values. And I decided to leave Goldman and join him in an RIA that we kind of then co-founded over again together. So it was just the two of us building really with mass affluent customers, people that were regular Americans. A lot of them were Lockheed Martin engineers. He was a Lockheed Martin engineer prior. My partner, Jeff. And so long story short, we're building this firm, and he had built some financial planning software. It was really sophisticated Excel-based, but there was some VBA code that he had written, several Excel files that worked together to build a PowerPoint presentation. And I had this epiphany one day that, man, if we can take that software and put it online, simplify it, I can create a big impact. And initially my vision was to build that firm. Over time, how that happens, we spun that out and started a different company called My Financial Answers. And the initial vision was actually to offer financial planning to employers in the workplace. So we spent some time in the Silicon Valley, talking to some of the forward-thinking companies like Facebook and Tesla, doing some, kind of piloting at the time. And I'll never forget it. There's the guy that runs financial wellness at Facebook. He still does today. His name's Josh Newmister. Josh, talking to him about what we're doing, he said, Ben, our employees need this. They need, financial planning. They need a more comprehensive view. It can't just be about their retirement. It's got to be about, can they afford to buy a home, and they're having kids? What does that mean for their life? But Josh said to me, he said, Ben, he's like, the reality is companies like Facebook, we don't want another vendor, and we don't want to pay for this. So he's like, go talk to, Fidelity, who has our 401k, or go talk to Schwab, who has our stock plan. And I knew at the time, like, I can't go talk to those guys. But long story short, he put me on this path of talking to plan advisors. I was like, oh, my RIA, we've got 3 401k plans. Surely there's got to be advisors out there that have 25 or 50 or whatever. And so I discovered this whole world of plan advisors. This is probably around 2015 or so. And so I just dug in and long story short, I'll fast forward. We started to get some traction with plan advisors. Actually, frankly, in the 403B space, because they had this incentive to actually meet with individual participants in order to build their business. And, the business was kind of plugging along, but we were undercapitalized. At that point, I'd raised, close to $1 million, and I didn't want to raise any more money. We didn't have the traction to justify, going back to my investors and saying, let's raise more money. And so I was really just keeping the lights on, and frankly had this vision that there was somebody bigger. At the time, I thought it would be a strategic, right? Some financial services company that could take what we had built and go from there. But long story short, after a few years of kind of frankly keeping the lights on, I'd taken a job at another startup called Pickwell, and I was heading sales and marketing. It was a or health insurance decision support company. We were selling into a lot of the guys that are aggregating retirement plans now, Hub and One Digital, those firms. But long story short, I was introduced to Vinay at TIFIN, and by a good friend of mine here in the Denver area. And they were thinking about doing something in planning. They said, "Hey, Ben, we like your vision. We'd like to start something. Why don't we just acquire what you've built and you can come on here?" So that was the origin of what is now TIFIN Plan, which now sits under a series of platforms called TIFIN Grow. It's a planning tool, a risk assessment tool, formerly Totem, which TIFIN bought. It was based in Atlanta. Cool platform, and then a personality assessment as well that sit under one single platform. And so that's how I got here. Learned a lot along the way, what it meant to be a technology entrepreneur. It is not easy. But I love being here at TIFIN.
Oh, you don't say.
Yeah, Josh, you're right in the middle of it. So you totally get it. So, but yeah, that's how we got here.
And so did that require like a kind of a rebuild of the platform that you had?
Yeah. So when TIFIN acquired what we built, it was essentially acquiring, all of the experience that I had trying to go out and build this and knowing the market, both on the wealth management side. And we weren't actually thinking about retirement plan advisors at the time. I mean, I still was in the back of my head, but Vinay didn't really have much of an interest in it. Mm-hmm. But we took the intellectual property, right? All the logic. I mean, financial planning is mainly just a lot of logic. We said, what we had built was still a comprehensive tool. It still took some time, probably a half hour at least to build this plan. And, Vinay's view is like, we can't take a half hour to do anything. We got to build things that are immediate, that are fast, that are more modern. And so we started over literally from scratch. We did use that logic and everything that we had as a basis for building, but we started with zero and wrote the first line of code. So today the team that we have is about 40 people. 30 of those are on the product and engineering side that are focused on plan, and then these other two capabilities that all sit in one. But it's all been, all that was even our risk tool, which was Totem, was acquired. It was probably 4 or 5 years in at that point. A lot of that platform has been totally rebuilt as well. So when TIFIN's most of our platforms were started organically from scratch, but there are a few that were purchased, and we kind of tear it down and build it back up. That's kind of the approach. So,
and so with TIFIN Plan, and correct me if I'm wrong, but it and part of this could have been kind of Vinay's maybe lack of interest, at least initially, with retirement plans, retirement plan advisors. Where you started to get initial traction, it sounds like, was on the wealth side, and that you guys aren't trying to be, like a money guide or an e-money per se, in terms of, I mean, those are obviously there's a lot of planning tools that are out there, but those are kind of the two of the 800-pound gorillas, right, in the wealth side. So most, I won't say most, but I would say many of the really top tier wealth firms that don't play in retirement but really play in the wealth space are using a money guide, or they're using an e-money to deliver this, more comprehensive planning experience to higher net worth investors. But that doesn't actually map super well onto clients that have maybe less sophisticated needs. So maybe like back in my advisory firm days, there were times when, we would have a high net worth client, and one of the things they would do is they'd say, well, can you work with, one of our, with our kids or something like that. And, they're younger and just kind of starting out, and we would kind of household them together. But, their needs, quite frankly, weren't the same needs that their parents would have. And how do you kind of address that? Or every now and then, we would get maybe some clients come along that didn't kind of fit our traditional kind of ideal client, but there was a strategic relation or reason why we would want to take them on.
Yep.
And it sounds like, if memory serves me correctly, that's in some ways, instead of like trying to retrofit Money Guide Pro or e-money onto these let's say, clients with less sophisticated needs. Instead of doing that, it sounded like TIFIN Plan, where you started, kind of slotted in really well. Like, hey, have another tool in the toolbox and use this lighter weight planning platform for those subset of, let's say, clients or relationships that don't need the really high-end planning. Is that a fair?
Yeah, it's a greatest. Our thesis was that there were advisors that already knew how to do planning. They were using those tools, and we had no desire to displace those tools, but that they had use cases where they just demanded efficiency and required simplicity, right? So the use cases that we see that advisors on the wealth side are using TIFIN Plan are, next gen clients. You just said it, the kids, grandkids of wealthy clients. It's, younger clients for advisors that are building out businesses with Gen X, Gen Y, Gen X, Gen Y, Gen Z, I guess at this point. And then what's interesting is the way we got with plan advisors was our message was all about streamlined, simple. That was the message that we were putting out into the market. And all of a sudden, plan advisors started showing up and saying, hey, we need simplified planning so we can do this in our one-on-one sessions with, I've got 20 minutes or a half hour with a plan participant. And so I noticed that about 20% of the advisors that we would, and this was all me, right? In the early days, I was the only salesperson, like reaching out and talking to advisors. About 20% of those advisors were plan advisors, right? Now, they might have a wealth management practice. Actually, all of them had a wealth management practice, but there was someone on the plan side that needed that efficiency. And so I was already familiar with the space, right? I had already built my financial answers. I wouldn't say Vinay wasn't interested in plan advisors. It was just our focus was wealth.
Maybe priority is a better way to say it.
Yeah, it was just like we were focused. He knew who the wealth managers were. We were building everything for them. And but long story short, these plan advisors started showing up, and I just started listening to, okay, what are the other needs that they have, right? They work with 50 different employers. They need to be able to configure the platform for those employers so that we can do it faster. It was all about how do we make it more efficient. And so we started listening to them and realized over time, even some of our there's workplace initiatives that Morningstar has advisor managed accounts, and they've got a workplace business. And so I was just able to slowly kind of drip on, frankly, our leadership here that I thought there was an opportunity to work with plan advisors. And so we're squarely in the middle now of taking the same platform. And it's not just TIFIN Plan, by the way. We've got other capabilities at Clout, for example, which is a digital marketing platform, but it's digital marketing and digital education are essentially the same thing. You're trying to personalize education for people. We're bringing those.
Maybe the audience, quite frankly, leveraging, as I kind of understand this Clout, right, for traditional wealth firms, right? They're trying to find these kind of high net worth clients, and that may be the audience, but being able to leverage some of Clout's capabilities. I mean, effectively, if you've got thousands to tens of thousands of participants within your retirement plan book of business, that audience being able to leverage those kind of Clout digital marketing capabilities to this, that is the one nice thing is you kind of have this embedded group of people that you've got access to. Is that fair? Like leveraging?
Fair. Some of them are 25-year-olds that are thinking about getting married, and others are 35 and they're buying their first house, and others are 63 and they're thinking about retirement. And what Clout is able to do is engage those individuals, see what their activity is. What are the articles they're clicking on? Oh, this 35-year-old is clicking on an article about buying a home. So let's personalize the engagement for that individual. Let's hyper-personalize it. And oh, by the way, when it comes to TIFIN Plan and the interactions that those people can take with our platform, like let's tell them how much home can you afford is one of our modules, right? Like we don't have to talk to them about necessarily retirement as the first thing we talk to them about. Let's talk about what's relevant for them. And so, long story short, that's how it all came together. And so we've still got work to do on the plan advisor side. And frankly, everything we do, we're collaborating with our customers to continue to build and refine. And so we're in the middle of that process now. But it's been refreshing to see the reception from plan advisors. And, frankly, there's lots of trends that I've heard you talk about that are happening on the retirement plan advisor side that are kind of driving this, right? We're not driving, hey, we have this big idea. Like there's a reason that plan advisors are trying to change that participant experience and create more personalized experiences. And hopefully we're just, kind of going to ride that wave and provide some innovative solutions that allow them to do that better in a more personalized way.
Yeah. And I was impressed by, just with the platform, in that it was more looked like a modular approach, right? So you obviously can kind of pull things together in more of kind of a lightweight but comprehensive way, but that doesn't have to be, the ticket to the dance. You can start something more modular. Hey, I'm buying a home. Hey, I'm getting married. I'm having kids. Do I have enough insurance? Like, you can do you can do modular. And I think that's really, when you think about, the trend towards, wellness and engagement with retirement plan advisors, is you can't deliver economically. And I'm probably I might be in the minority in this, but when I talk to people kind of like, offline, people tend to agree. I'm like, it's really hard to make money in wellness. It's the economics of it. You have to be efficient, and quite frankly, you need to be more on demand, because the vast majority of participants neither need nor do you have the kind of the powder to be able to support a comprehensive approach, like bringing that bespoke high net worth kind of experience down market. It just doesn't work. But the planning piece, I think is really important. And obviously there's an arms race right now. You've got all the big record keepers that are rolling out, and I've talked about it a bunch on the podcast, but you've got this kind of frenemy situation going on, right? Where, Vanguard and Fidelity and, Empower with buying personal capital, like everybody wants to own the participant experience, and people are trying to be able to drive this kind of convergence discussion and whatnot. But it's really hard to deliver services to participants, at least in my opinion, in a really in a super profitable way. In fact, most advisors that are dealing with the participant stuff, if they've got wealth teams, I hate to say it, but what they're trying to do is they want to spend as little time as possible probably working with the rank and file that wouldn't be good private clients, and they want to kind of use it as a way to kind of uncover and mine, maybe the 2 to 5 people in any 100-person company that actually have the means to be good wealth clients. And so efficiency and from a tech standpoint is really, really important. I think the other thing that I would say is just people need planning help. And I actually think advisors are in a much better position to deliver fiduciary-based on-demand advice to participants than than some of the large record keepers. Not to knock what they're doing, but I did a study before I left Greenspring in 2019 called Seeking Clarity, and I surveyed almost 2,000. I had almost 2,000 participants fill out a 75-question survey, and we had an 89% completion rate, which is off the charts. But it talked about 10 categories of kind of, financial life from a comprehensive standpoint. And what was very interesting was, we all know the stats of people being very stressed about their finances, but only 24% of people had a written financial plan. And my theory was not having a written plan was what was driving a lot of this stress, because people felt out of control. And one of the questions I asked was, who was the best person to provide advice? And 40% of people said that an independent fiduciary advisor was the best source of objective advice. Only 12% said they thought the record keeper was. And so that's kind of a long-winded way I bring that back, is that advisors are in the catbird seat to be able to do this, but economically they have to be able to do it efficiently. Like you said, they can't spend 30 minutes building out or an hour or 2 hours building out a plan. And I think that's when I looked at TIFIN Plan, it was like, wow, this is something where You can reach out, you can market to folks, you can personalize it from that standpoint. And then on either a module driven approach or more, more fully featured, but still efficient, you can deliver, a plan that quite frankly meets the needs of most of those folks, which have less sophisticated needs than high net worth.
Yeah, I think it's really critical. I mean, at the end of the day, all of this has to be focused on the participant and what their needs are, right? That's the only way any of it will work. But the plan advisor, in order to be able to do that, has to be able to offer, take that 100% of a participant population. Let's say it's 1,000 employees, whatever, 100 employees, whatever the number is. As you said, 3 to 5 of those probably could be, consuming some wealth management like service and can either afford to do that by paying out of their pocket or, maybe an employer's paying for it, whatever. My view is that there's got to be, kind of modularized tools that a participant can engage in, but it's got to be engaging in what they care about, right? It's got to be engaging around, buying a new home, or do I need more life insurance? It can't be about retirement. And, to the extent you can provide those tools, that provides value to everyone. And then if the plan advisor is the one that sort of owns this experience, and we can talk about this owning the data, my view of who owns the data is whoever engages the participant and earns the right to own their data and own that relationship. I know there's a whole nother level of that conversation.
I would argue that participants own their data, not anybody else. But to your point being,
they're going to give it to whoever provides them a good service, right? That's the reality. So, but
own the relationship, I think maybe
exactly
describe it is whoever provides the best solution.
Value. So value. So, my view is like there is that existing participant population that you could use an eMoney or Money Guide Pro or whatever the tool may be with and go into a deep relationship with. There's the other, call it 95% that you can't. And, my view is that what TIFIN Plan allows is for all of those 95% to get more value. And then essentially for, I don't know if it's another 10% or 15% of the population that frankly isn't that far off from that top 5% and one day will be that top 5%, a way for an advisor to engage with that individual in a way where they can actually develop that relationship, right? And to, as one of your other guests put it, start to cross-solve for those individuals. So now the planning tool.
Shout out to Jason Chepnick for that.
Yeah, I listened to his podcast. Yeah. So the planning tool is a planning tool, right? It's that engagement, and we build it to be real time, right? I'm sitting with the participant, whether it's on a Zoom call, face to face, whatever it may be. I still believe that engagement component is critical, right? Like, how do I actually drive people to things they care about? And that's where the Clout capability that we have comes in, where we're using artificial intelligence to identify who are these people, what are they interested in, how do they fit into a broader category of individuals, and then how do we gear content to go to them? How do we hyper personalize plan education rather than just doing the once a year, twice a year session around retirement, right? Like we can literally
deliver their behavior and their engagement, not the advisor basically driving that experience, but more of how people are engaging kind of with the platform. You've got the intelligence and
now there can be inputs into that are advisor driven. So for example, if the advisor does a webinar, right, we can capture through an integration, a two-way integration with Zoom, we can capture that this person attended this webinar around retirement, right? And so it's not just the content that sits on Clout or what they did in TIFIN Plan. There are other sources of information that could come from a CRM platform, could come from Zoom, that also impact that. And so we're trying to create this profile that allows us to engage that person in a hyper-personalized way. And it's constantly learning from what I'm doing, it's constantly learning from other people that are like me. So it could suggest things that, oh, you might like this because you liked that, right? Just like Netflix would do. And that's what Clout's doing. So we're pulling these capabilities.
Personalizing individual journeys, if you will.
That's 100% right. Actually, in fact, I just finished a slide that I'll present later today to a large retirement plan aggregator, and it is showing that what that journey could look like, right? So journey could look like advisor does a webinar. Jane Doe signs up for the webinar. Jane Doe attends the webinar. Jane Doe gets a follow-up email that says, hey, use TIFIN Plan to figure out, are you on track to retire, right? Jane Doe does that, doesn't schedule a meeting to talk to the advisor. Clout follows up with Jane Doe. She doesn't engage, right? Clout decides, look, let's send this financial personality assessment to Jane Doe and see if that engages her, right? Like, what's your first financial personality? It's one of the platforms we have. And Jane's like, oh, well, this is interesting. She fills out the assessment. She realizes she's a values-based person and she's interested in ESG. And so she fills that out. She schedules a meeting to talk to the advisor about her personality, her financial personality. During that meeting, the advisor is able to engage Jane, not just about her financial personality, but say, hey, have you thought about, are you on track to retire? She's now engaged in that discussion. And advisor is able to help her, increase her 401k contribution, maybe change her, go into a different model or whatever it may be. And then, maybe further down that journey, Jane becomes a wealth management client, right? Now that journey could look very, very different for any individual participant. That journey could start with how much home can you afford, right? Because Clout learns, somebody clicked on an article that's about that, and we suggested, how much home that journey might take 2 weeks for someone, that journey might take 2 years for someone else. But that's what Clout's all about, personalizing that journey. And frankly, TIFIN Plan's all about, we talk about personalized financial plan, right? The reality is financial planning has been, it's your personal financial plan, but it's the same process we go through with every single individual, right? It's personalized as long as you like it this way, right? So what we're doing with Plan is allowing advisors to personalize the planning journey. Like, let's literally talk about the issues that you care about. What are the acute pain points that you have today? And then we can talk about retirement later, right? Like, it's just not something that's top of mind for you. So, anyway, it's a lot of fun.
One of my philosophies is that you systematize the process, you personalize the relationship.
Yeah, 100%.
Right. But if you look at planning and some advisors try to do this, but this idea, planning, 90% under the hood, it's the same kind of like rules-based kind of planning approach and methodology. Yep. It's just that 10%, kind of the iceberg effect, right? 90% of the iceberg that's under the water that you don't see is systematic and kind of the same process. Yeah. It's the 10% above the water that you see that is going to look different based on the unique kind of relationship with the person. So, as you guys have moved kind of into this retirement plan advisor space and starting to see, this kind of segment is potentially a good fit for TIFIN Plan and what you guys are trying to do and the other tools. What have been some of the biggest challenges that you've run into in dealing with retirement plan advisors, and how are those maybe different than what you've experienced, both having been primarily a wealth advisor, and then where that would be kind of like where I would say kind of your starting point was?
Yeah. By far the biggest challenge is the ecosystem, right? So on the wealth side, you've got TD Ameritrade and Schwab as custodians, which are, in my mind, equivalent to a record keeper, right? Well, they've said, hey, we're going to open up our platforms and we're going to integrate with these fintech tools like eMoney or whatever it may be, which makes it easy for advisors to adopt different platforms. On the retirement plan advisor side, obviously, I'm working with, at the very least, I've heard three record keepers. Oftentimes you hear 13, 15 different record keepers, right? And so I think that ecosystem is not set up today to really innovate quickly. And, you've talked about it before. There's not a whole lot of incentive for the ecosystem to adjust. My view is that, ultimately, no technology company has ever sort of changed the world, if you will, by asking for permission. And so my view is, like, we have to do what we're doing irregardless of who a record keeper is. Our view is that the retirement plan advisor is the best path to take the innovative technology in. And if it works, record keepers will integrate at some point. Now, it might not be the Fidelities of the world and those sorts, because they've got their own sort of closed ecosystem, if you will. But my view is that there is an independent record keeper channel, and those names and those folks, I think are trying to compete with those larger record keepers. So at the end of the day, competition is what will drive that. But I think that by far is the biggest challenge is, people say, oh, how do we get the data in? By the way, I also think we overestimate how valuable that data is, right? Like, how hard is it for me to figure out what somebody's age is, what their family looks like, what their salary is? If I have an engaging experience, it's not difficult for me to get that same exact data. It's a little bit more difficult for me to see into their portfolio, right? Like what their fund lineup is, what the models might be. But again, we can work with advisors in a way to enable that data to come in even outside of a record keeper. So I think that's the biggest challenge. I think another challenge certainly is, to your point, how does this get paid for, right? I agree with you. Financial wellness is, for a long time before I came to TIFIN, we had categorized what we were doing as financial wellness. I still think what we're doing at TIFIN broadly is financial wellness. But in the employer setting, at the end of the day, there's very few examples of employers paying for this, right? It exists, but it's, a small percentage of employers. And I think I said this to you when we were demoing. My view is that the plan advisor has to, be on board with taking this in. They have to see the benefits of it. But I do truly believe there is a wealth management component of these firms that has to actually fund this, right? And so in any RIA, this is just me being very honest, in any RIA where you've got high net worth clients, ultra high net worth clients, and then some mass affluent clients, and I've got an RIA that looks like this, those higher net worth clients inevitably subsidize the services for those lower net worth clients, and that's just how it works. And so I feel like from a compensation perspective, it has to be a firm perspective. To me, this is why this sort of convergence of retirement and wealth is important. I mean, that's a trend that kind of has to play out, and I think it's already playing out. In order for us to have success, there has to be incentive for that retirement plan advisor, the human in that firm, to take this in. And there has to be some other revenue source that comes from this. I do think over time that revenue could be sort of wealth management services that occur in plan, right? Like I think that's a way things could happen that, as innovation happens on the product side in plan, right? Managed accounts, guaranteed income options, that wealth management could happen in plan. There's obviously lots of, ERISA issues to navigate for all that to happen, but ultimately, I think that's a challenge that's got to get solved. And you and I have talked about it before. There are firms that are already doing this, right? There are some large firms that are doing wealth management. They're also doing retirement. There's things that are working together. And my view is there's going to be winners and losers, right? And the ones that are doing it are absolutely winning. The question is how's everyone else going to sort of bridge the gap between retirement and wealth? How do you have tools that make it efficient enough that you can do it? How do you deploy this across, plan sponsors? And so it's not without challenge, but, my personal view is if it's not challenging, it's probably not worth doing it. So,
yeah, it's been interesting to me. Just I would say, and I don't know if I've mentioned this on the podcast, but living in the tech world, there's some interesting perspectives. So going back to your thesis, and you're exactly right, is I think the reason you've seen a lot of the fintech investment chase the wealth management side of the business is for a couple of reasons, and you kind of highlighted them. One is, especially on the independent RIA side, I mean, there's a handful of large custodians. You got Fidelity, you got Schwab, you had TD, but TD bought Schwab. You got Pershing. Like those are probably on the independent RIA channel. Like those are the three biggies.
Yep.
And they've got platforms. We had at Greenspring that enable and they open up that data. That's why we were able to leave the wirehouses 20 years ago. And it's because you had these custodians that would say, hey, we're going to, at the time we used Schwab Portfolio Center to, for our portfolio management, which there's a whole different story of itself, but that you could connect with the custodian, you could download the data, you could manage portfolios, you could do performance reporting, you could do billing, you could do all of that. And so on that side of the business, these custodians are very open to providing access to the data. And so you can get now these technology tools that utilize that and leverage that. And I think what's happened is on the retirement side, and you even look at a Schwab or a Fidelity. I mean, they have obviously large record-keeping businesses, but those are totally different businesses than what the wealth side is, right? And so there is an incentive. There is, and a lot of it is couched in terms of like cybersecurity. But the reality is, these big custodians, like on the retirement side and even on the private wealth side, I mean, they compete with their channel, but the retirement side wants to lock down that data. They don't want to open that up. And that's been why I think a lot of fintech investment hasn't gone into the retirement space. And that's why, quite frankly, that's why I built Fiduciary RX, is like, hey, let's have some modern tech on the retirement side. Because a lot of the tools that are out there, they're legacy, and in some cases, they're 10 to 15 years old. They're a little bit antiquated. But what's been interesting with advisors, wealth advisors generally view technology as an investment. And I've seen retirement plan advisors, their kind of natural proclivity is to view tech as an expense.
Yeah.
And the irony is, and it's always like, well, we're less profitable on the wealth side. But the irony is, well, if you had better tools and you applied that, retirement plan advisors are notorious. They still do so much on a manual basis. And that's partly why profitability is lower. And so, what you're trying to do, what I'm trying to do, what some other, I think newer tech players are trying to do is, how can we more efficiently help advisors work smarter, work faster, and leverage technology. And my kind of value prop to a lot of advisors now that I talk to is like, hey, instead of like your next hire being a person that you have to train, you have to pay, you have to get up to speed, use technology as your next hire.
Yeah.
That may push out your hiring curve by 12 or 18 months. You can create capacity. If you have capacity, now you can redeploy that into, growth and revenue generating, opportunities. And that's why I was really intrigued by TIFIN Plan, is because, again, I think you did a good job user experience. Like it's efficient. And just advisors in general and listeners, don't take this the wrong way, because obviously I sat in the seat for a really long time, but like, we don't like things that require us to put forth a lot of effort. We want things that are going to be easy and that are going to be efficient. So, and that's your platform. I saw that. That's what I kind of felt like, if that makes sense.
Yeah. I think the other thing is with respect to what we're doing with, what we're now calling TIFIN at Work, which is some elements of Plan and Clout and our risk tool. I think it's necessary to view the tech as the investment, but I think even more broadly than that, I think what plan advisors have to buy into is the participant experience being an investment, right? Like at the end of the day, that participant experience is, the expectations for that are only growing. And so regardless of why I don't think it really matters why. The reality is that participant experience is becoming such a focus. And so from my perspective, if the investment is the participant experience, technology is an absolute necessary enabler to make that a better experience. And my view is you can't really rely. I mean, look, some record keepers have great experiences. Some experiences aren't all that great digitally. But you can't rely totally on a record keeper experience, right? Like my financial life goes so far beyond this one 401k account I have. I might have some IRAs here, a Roth IRA over there, an HSA here. I've got some life insurance, right? My financial life is so far beyond what I'm doing with my current employer and the record keeper there. So now some of the larger record keepers are touching some of those other areas, but in general, most are not. So I think the investment is the participant experience, and you have to invest in technology in order for that to, for your firm to stand out. So we're trying to do our part over here to enable that, and it's been a lot of fun.
And so I don't know what those.
That's my calendar blowing up.
That might have been your calendar blowing up there, Ben. See if I can edit that out post production. Where you guys are, but where do you see kind of the future of fintech going?
Yeah, there's lots of different areas of fintech. I'll speak to what kind of the segment of fintech we look at. There's payments. We're obviously in what we would consider sort of this this
Wealth tech,
personal
maybe,
finance or wealth
maybe
tech.
wealth tech, if you will.
Yeah, actually, I was at the wealthmanagement.com or Wealth Management Edge conference down in Florida last week, and our CEO Vinay was on stage. He was up there with the CEO of Orion, which is obviously wealth tech, and then there was a pretty senior guy from LPL, and their whole conversation was around personalization. And ultimately, our view, and this is why we're doing what we're doing at TIFIN, is that as people get more personalized experiences in every other area of their life, they just expect that they get personalized services in wealth management or financial services. So, personalization requires that you actually know who people are, what their preferences are. And this is why you see trends, and you talk about there's like the ESG trend, right? And that exists in some places, it doesn't exist in others. But that is one example of personalization. But personalization requires that you, frankly, just understand somebody, on a deeper level. And so our view is that there's just got to be more inputs into what you know about someone in order to personalize for them. So that's why we've created, TIFIN Personality, which is this personality assessment to understand kind of who is somebody deeply, like what motivates them, what are their, what do they value, what do they think about what's going to work in the future, right? Do they care about they think blockchain is going to work, or do they think, social media is the future? So in that case, personalizing a portfolio comes down to actually understanding what somebody views outside of, just what my retirement plan is, or just what my risk tolerance is. So I think broadly it's personalization. Obviously, technology needs to enable that. And in order to do that, it requires things like modern technology, artificial intelligence, machine learning, big buzzwords. But I mean, at least here at TIFIN, and I'm not a part of this, right? I'm on the commercial side of the house, but we've got some people that understand that deeply. And the industry has to invest in more modern tech, like rules-based engines aren't enough. TIFIN Plan, a part of what we're doing at TIFIN Plan is using conversational artificial intelligence as the primary mode of engagement. So I'm actually typing data in as a conversation. And it's sort of, that kind of comes back to personalization. How do we interact with people in a way, whereas modern consumers, they kind of want to interact. And our view is that they don't want to fill out forms. so it's a
really cool thing when I saw the platform was, and I didn't get too deep under the hood with it, but there was like this chat feature. And as people are kind of this unstructured, right, structured data that can go into a form or can go into a Excel, into a cell in Excel or something like that, right? That's structured, but language is unstructured by, I think by definition. And I thought that was actually pretty interesting. What you were saying is as you could be chatting with a participant.
Well, it's a more personalized experience too, because the system can now talk back.
Yeah.
And the system can educate you as you're putting data in to keep you engaged, just like an advisor would. Right. So,
which I thought that was pretty interesting. And again, this might be not a super popular take, but I tend to have those. But on the retirement side, still people even thinking about managed accounts, right? It's an investment driven solution.
Mm-hmm.
On the RIA side, with a lot of the wealth firms, 15 years ago, wealth management was really probably defined as 90% investment and 10% planning.
Yep.
And I would say that there's a lot of margin if you're just managing portfolios for individuals on the wealth side. You've got some margin compression, you've got fee compression, just the value of just the investment piece alone. I think you can kind of use the market. It's probably 25 or 30 basis points.
Yep.
The planning, if you're going to charge 100 basis points on the wealth side, the planning is where that extra 70 or 75 basis points is coming from.
Sure. Yeah.
And, most really good wealth firms are much more planning first and investment. Instead of leading with that, it's more of the investment component is like a subset of, it kind of follows the planning. It doesn't lead the planning. Yeah. And I just think it's interesting what you talked about, like with Orion, right? Which being and talking about, on there about personalization, like, yeah, can you personalize portfolios like managed accounts? Absolutely. But it really comes down, the personalization is around the planning. Investments are something that advisors have very little control over. Markets, little to no control over what markets are going to do. Certainly can have some control over portfolio construction and discipline with rebalancing. But what advisors have a lot more control of on behalf of their clients is around planning strategies. And I think that ultimately, to your point and what you guys are trying to build is, like, I think you can get a little bit better personalization on the investment side, but there's a whole opportunity to get much more personalized on the planning side. And that's where the real value, and where, quite frankly, you can derive a lot more value to justify your fees than just, hey, we have a better mousetrap to manage your portfolio better.
Well, this is one of the things that always shocked me, Josh. Like, and I've heard you talk about managed accounts a lot, right? And maybe it's 25, 35 basis points, whatever that number is. But maybe you know the answer. Like, why today can I not layer on a financial planning service within a retirement plan environment and pay a higher fee, right? Like, that fee is justified. Now there's, charging fees in a record keeper, more challenging, all that stuff. But at the end of the day, like, fundamentally, I don't think there's any reason why a plan sponsor shouldn't allow an individual participant to opt in to a service that is just more valuable, because it is investments. There's planning on top of it. And by the way, I can better personalize a portfolio if I'm doing the plan, right? So, ultimately, I think that when I talked about sort of how does this get paid for, I think that's another way that they can get paid for. I remember I listened to Kitsis on your podcast, and he was talking about how advisors are now using AdvicePay, plan advisors are using AdvicePay to offer subscription type services within the retirement plan environment. So that's probably one way to get there.
And you can, but I think that what that is, where that component is it's really offering services and having opt in. Like, you're not going to get a plan to pay for it per se, but being able to kind of opt in, like, hey, I've met this advisor, they manage our 401k plan. There's obviously some services on the investments with the assets that are in the plan, but how do we now engage in a planning relationship that is outside of the retirement plan, but that I basically was introduced into that relationship through the retirement plan? And then using, again, like you said, some subscription. I think in the small, that's the retrofit is, historically percentage of assets, right, on the wealth side, because you've got high net worth investors who have enough in assets to be able to pay for it. If somebody has, $50,000 in assets, and you try to charge them an asset-based fee, you charge them 100 basis points, you're making $500 a year. Your economics are going to be more services. Yeah. So I think you're seeing evolving models. You're seeing what Michael's doing with XYPN, right, with kind of serving, and it is that, that Gen X, Gen Y, Gen Z, who they're younger and they have high, which is a lot of retirement plan participants, right? They have high human capital, but low financial capital. Whereas when you have older people who've retired, they've got low human capital and high financial capital. Right. In that case, an asset-based fee structure is going to work. Yep. But people that have low financial capital, but high human capital, an asset-based approach doesn't work. That's where you're starting to see evolving models like, hey, we're going to do some type of monthly subscription that kind of takes care of the planning from that perspective. And I think those compensation models, that's what's going to have to evolve and change. And just if you look demographically within the culture, right, we're much used to paying for, subscriptions much more. And I would even marketing wise couch it as like, look, you got people who pay, my wife is a yoga instructor, and, there are people at the couple of gyms she teaches at, like, they pay $200 a month for a yoga membership, right? Think about that. Think about couching it as like, hey, this is you're going to spend $200 a month on a, or 250 or 200 plus a smaller basis point on your assets, whatever that looks like. But, you're going to get, it's like a financial gym membership, if you will. And I
just started paying I was paying $200 a month, but I dialed it back because I didn't have time. But $50 a month for virtual golf lessons. You were telling me your son's a good golfer, and I'm like $50 a month to be able to call this golf instructor before I play around or after I play around. I video myself. There's all the technical analysis on the screen. He gets right back to me. It's amazing. So I agree with you. I think that those evolving models should influence not just wealth, but also the retirement side as well.
Yeah, 100%. All right. So, a lot of times I ask guests kind of, what they're, from a fiduciary perspective or from a plan perspective, like what's their number one piece of advice, for, those of us in kind of the fiduciary, world. What would be, as you're speaking, and lots of advisors listen to this podcast, like what would be your best piece of advice, having been an advisor, now, a technology entrepreneur, like what would be your greatest piece of advice to them as they're thinking about, convergence and ways of both kind of protecting their existing business, but creating business opportunities through it?
Yeah, I'm a little bit biased here, but and this is just kind of what my personality is, but I feel like at times we overemphasize the implications of the rules, right? Like there are rules, they are very serious. Like we are fiduciaries, we can be, sued personally, and that can be very bad. But I think sometimes just use creativity and think outside of, what we think those boxes are. I think we have more flexibility than we think we do. And don't ask for permission. I mean, at the end of the day, if we're waiting for, and again, nothing against the record keepers, there's lots of great record keepers out there, but if as a plan advisor, you're waiting for a record keeper to solve your problem, you're probably going to be waiting for a long time. So, I think that plan advisors have the absolute power and relationship with their plan sponsors to frankly be a part of creating the solution that they need. And they don't have to be the ones kind of sitting around and waiting. So that's not for everyone, but certainly there are some plan advisors out there that I think probably are frustrated and want to create a better experience. And, it just requires plan advisors to be a part of that solution and not sit back and wait for permission. So, and all that can be accomplished, I think, within the context of, Department of Labor laws and tax code, all that can happen. And frankly, I think the plan advisors are the ones that know those rules, other than the attorneys, the best, right? So you can influence technology and innovators and providers by saying, hey, I know you're building this, but keep this in mind. So I'd say don't ask for permission. Figure out how to collaborate with technology vendors. I mean, even with you, Josh, I'm sure that's a big part of how you're building the platform. Like I have so much experience, you have so much experience, but all of the ideas and knowledge of all those other, plan advisors out there is what it will take to create not a perfect solution. It's never going to be perfect, but a solution that works and is moving the industry forward. So
if I summarize, I think what you said, the way I would describe what you just articulated was be proactive and challenge conventional thinking.
Yeah.
That there will be winners and losers. And, you part of that challenging conventional thinking is kind of the heart and the soul of innovation. And then the last thing I would just say, and this is hard for financial advisors, but a lot of financial advisors, a lot of retirement plan advisors, they get paralysis by analysis. One of the things that I think helped enable, some of the success I had over the years was I wasn't afraid to fail. And I viewed everything as kind of like an experiment. I have a hypothesis. I'm going to run an experiment. And sometimes that experiment proved out my hypothesis. And sometimes it proved out the fact that like I failed because it didn't do what I thought it was going to do. But rather than being overly cautious and scared about failing, like failure, that Thomas Watson, who was the CEO of IBM, if you think about IBM Watson, it was named for Thomas Watson. And he had a great quote. He said, I'll give you the secret to doubling your rate of success. He said, double your rate of failure. The more you fail, the more success you wind up having. So, Ben, this has been an awesome discussion. Really appreciate it. Where can listeners go to connect with you or learn more about TIFIN in general or TIFIN Plan, what you're doing? How can people stay connected with you?
Yeah, website is TIFINwealth.com, TIFIN wealth.com. I'm on LinkedIn. I'm on Twitter. They can find me there. I'm happy to provide that to you so you can put it in any show notes or anything you distribute. But yeah, I would love to hear from anyone out there that's kind of thinking about these things and all about ideas. So I appreciate you having me on, Josh. It's been a lot of fun and been great getting to know you, and appreciate all the advice you give me along the way.
Awesome. Well, thank you so much. Been a great conversation. Excited about the things that you guys are working on, and I think what the future holds, and given the role that I'm in now, I feel real kindredness to you as well. So thanks for being on the show, and in the show notes, as you said, I'll put links to for people to connect with you on LinkedIn, but also to learn more about TIFIN at Work and TIFIN Plan and all the cool things that you guys are working on. So thank you so much.
Awesome, Josh. Thanks.